Whether you're a federal government employee or a military member, there are three investment accounts you need to retire comfortably. And I'm going to show you these accounts and how to calculate your total retirement distributions. And there are almost 4.5 million military and civilian personnel working for the federal government. And my goal is to help every one of you understand how the thrift savings plan or TSP works, so that you don't retire with nothing invested. And when I was on active duty in the Air Force, no one ever taught me how to invest in my TSP. And my money was actually in the G fund until I realized how much my TSP had not grown for almost 8 years. And guess who benefited from me by investing my entire TSP money in the G fund?
I need answers.
When I got smarter with money and started my business to help people with their financial journey, I learned that I needed three investment vehicles in order to retire comfortably. And the first one I knew I was gonna get was my pension income. In the military, you'll get a pension if you serve at least 20 years. And if you retire as a federal civilian employee, your pension calculation is slightly different from the military pension, but generally speaking, they both calculate your high threes salary, your total time in service, and the multiplier that comes with it. And keep in mind that the rules are different for those who retire as law enforcement officers, firefighters, or nuclear material couriers, whatever it is that they do. And I'm not going to get too in depth about this, but you can always search for my pension video by going to my YouTube page. And the retirement calculation is also different for the military if you're still under the legacy system. So the first investment vehicle you need is to supplement your pension, right? And that would be the health savings account, or HSA. And this is only available for federal employees because military members are on TRICARE. So they're not eligible for the high deductible health plan or HDHP. You can always get an HSA if you decide to become a federal employee after you separate from the service. And I'll explain a little bit on how the HSA can supplement your retirement income. For the year 2024, you can contribute up to $4,150 if you're a single individual, or $8,300 for a family. And if you're over the age of 55, you can make an extra $1,000 in catch-up contributions. Your employer could also contribute to your HSA if it's in your high deductible plan. And the next investment vehicle you need is a Roth IRA. And every dollar you contribute directly to your Roth IRA is an after-tax or post-tax dollars. And while the contribution limits are low at $7,000 or $8,000 if you're over the age of 50, this is the account that you can take everywhere you go. And a lot of people misunderstand that. If they have a TSP, then they can't contribute to a Roth IRA. That's not the case at all. You can contribute to your TSP and the Roth IRA in the same year. And after you leave the federal service as a civilian or military, then you can't contribute to the TSP anymore. However, you can continue to contribute to your Roth IRA as long as you're actively employed. And the next investment vehicle is your TSP. For the year 2024, you can contribute up to $23,000 in either Roth or traditional TSP, or a combination of both, as long as you don't exceed $23,000. If you're over the age of 50, you have the extra $7,500 in catch-up contribution. That's a total of $30,500. And the TSP is going to be the biggest investment vehicle to supplement your pension income. And I have the TSP calculator that you can download for absolutely free by visiting firesightchat.com/resources. And you can also schedule a free session with me if you're interested in joining my private client program by visiting firesightchat.com/coaching. And here's what happens when you retire. Nobody really talks about this unless you talk to someone who has already retired. Your pension income, whether military or FIRST, is considered taxable income. The federal income tax bracket will start with 10%, 12, 22, 24%, and so on. And if you live in a state that charges your state income tax, you should find out if your state charges your military or federal pension income. Some states have a state income tax that doesn't tax military retirement benefits. And if you have a spouse, some of your pension will be deducted for survivor's benefits. The rule of thumb is about 10% of that. And not to mention that FEGLI, or your life insurance, FEBH, or your health benefits, and dental insurance can also be deducted from your pension. So as you can see here, your top line pension income could be, let's say, $40,000, but the bottom line could be so much lower if you don't plan carefully. And this is where your HSA can come in to help you pay for your medical expenses. A sizable HSA can help you pay out-of-pocket costs for medical procedures, treatments, over-the-counter drugs, and vision or dental copays. That's right. If you have to go get Advil, that's actually one of the qualified medical expense. And it just depends on how much you can delay your reimbursements from the expenses you pay out of pocket right now. For example, if you paid $200 out of your own pocket for a box of contact lenses and cleaning solutions, you can save that receipt and reimburse yourself many years later in your retirement. And there's no expiration date on when you have to reimburse your qualifying medical expenses with an HSA. So your HSA becomes your personal piggy bank, not to mention the fact that you can reimburse Medicare premiums when you turn 65. And remember that your Medicare premium will be deducted from your Social Security income unless you elect to directly pay for it out of the HSA. Also, when you turn 65, you can use your HSA for anything. And I mean for anything. You don't have to worry about those old receipts anymore. And if you did it before 65, the IRS would give you a 20% penalty. After you turn 65, you would just owe federal income tax and state income tax if state taxes apply to you. The HSA never expires and remains active as long as you're alive. And it is one of the most important investment vehicles because I know that my health in my 50s or 60s won't be as good as it was in my 20s or 30s. And my Roth IRA will come in very handy if my retirement income is much higher than anticipated. And depending on your financial situation, you should have an idea of how much you're going to pay in taxes when you're retired. And if you don't want to pay over 24% or 22% in marginal tax rate in retirement, you should have a plan to use a Roth IRA to reduce your taxable income. And your biggest investment vehicle is the TSP. If you're just doing traditional TSP, everything is tax deferred because you're delaying paying your taxes until you're retired. And if you're looking to retire tax-free, your investments will be in the Roth TSP because you're choosing to pay your taxes now rather than later. And keep in mind that even if you only contribute to Roth, you're still going to have the traditional portion of your TSP because your employer match is contributed in pre-tax dollars. And I'm going to talk about how I choose between traditional and Roth in the next segment. So be sure to subscribe if you haven't done that already. So let me give you a quick example here. Let's say your combined pension income is going to be $40,000 a year. That could be a combination of your military retirement pension, first income, or Social Security income. And you have to remember that your pensions were contributed in pre-tax dollars. And that's why you're going to owe federal and or state income taxes. You're also going to have to pay survivor benefits unless you and your spouse both elect to opt out. And you could also have additional deductions like your life insurance, dental, and health benefits. And if you only contribute to your traditional TSP, you have to remember to treat it like taxable income in the future. So if you have $500,000 total invested with a 4% withdrawal rate, you should only withdraw up to $20,000 a year until the portfolio increases even more. That's just a rule of thumb, right? You don't have to do a 4%, you can do 3%, you can do more than that. You just need to understand the margin between how much the portfolio grows year over year versus how much you withdraw. And again, this is where all of your employer match also goes to, and not just your personal contributions. Your traditional TSP and pension income should be counted as combined taxable income when you prepare for retirement. And if you have a Roth TSP after you turn 59 and a half, your earnings and contributions are tax-free because you already pay taxes on the contributions. And your Roth IRA could also be a great supplemental income if your taxable income is looking to be equal to or higher than your current income. And there's no one-size-fits-all answer to the tax question because your financial situation is going to be different from mine. But generally speaking, if your total pension income and other taxable income are, let's say, higher than 22 or 24% in the marginal tax rate, you should really consider having the Roth investments to minimize your taxes. And your HSA could really maximize your pension income by providing additional help on your healthcare costs. And the average retiree in 2022, according to CNBC, spent about $200,000 to $250,000 or more in total medical expenses in retirement. So we all know that the cost of our healthcare system will likely go up in the future. And this is again why I prioritize HSA over Roth IRA and TSP. And I also prioritize HSA because of its quadruple tax advantages. And if you don't know what those are, just be sure to check out my HSA playlist on my YouTube channel to get the full tutorial. And I know many of you TSP investors are wondering what's the right withdrawal amount when you're retired. And I hate to tell you it depends, but it really does depend on your total balance and asset allocation. Should you stick to the 4% withdrawal rate if your balance is less than $1 million? Or should you stick to the 4% withdrawal rate if your portfolio has more bonds than stocks. You might have to stick to 3% or even 2%. You might have a large portfolio where you can do maybe 5% in 1 year when the market does really well, right? And I encourage you to get with your local financial advisors to do some stress tests on your portfolio. You can always do your own risk analysis of your portfolio by using the Monte Carlo simulation in Excel like I did. What's the worst case scenario if the market tanks by, let's say, 24% like it did in 2022? Could you live just on your pension income and leave your TSP alone? A lot of people do that. A lot of retirees actually leave their TSP alone as long as they can because they can just live on their pension income. And do you have other income sources like real estate, business, or capital gains that can cover your retirement income in case of a shortfall? And you should really pay attention to how your portfolio is allocated. Is it currently sitting in the correct life cycle fund? Is it properly allocated between CSIG and F funds based on your age, risk tolerance, and your total assets? You don't want to be like me and let my money sit in G fund for almost 8 years. And this is how I have been prioritizing my investments since 2014. It's worked out pretty well for me so far because I'm debt free except for my mortgage. And it's nice to say that I now have enough in my investments to pay off my mortgage at any time. And that would be taxable investments, not my TSP or my other retirement accounts. The first step was to get the TSP employer match. By investing 5% to your traditional or Roth TSP, your employer will also contribute 5% of your income to your traditional TSP. But if you're in the legacy retirement system with the military, you're not going to get the TSP match, so you just simply skip step one. The next step I did was to pay off all of my high interest debt. This step took me exactly 2 years to pay off all of my $110,000 in high interest debt, like credit cards, car loans, personal loans, TSP loans, and many more. And I did all this when I was still on active duty in the military, and because my spending was completely out of control. And I'm proud to say that I haven't been back in any consumer debt in over 8 years now. So it took me a while to realize this, but the math just didn't add up, right? It didn't make sense to me to earn, let's say, 8% in the stock market while I paid over 10% in interest on my personal loan and over 25% in interest on my credit cards. There's absolutely no way for me to be where I am today if I didn't make the 2-year sacrifice to pay off my stupid debt. And I did a live stream on that. You can check out on my YouTube channel. Just type in $110,000 in debt and how I paid it off in 2 years. And then the next step I did was to boost my cash reserve so that I never got back into debt again. And I can't tell you how many times I needed cash for a rainy day, like replacing my blown tires twice in a month, and fixing my water heater and replacing my garbage disposal. I would have no doubt gotten back into debt again if I didn't have that cash reserve. So I actually didn't really start investing until I had a sizable cash reserve to cover my rainy day, home repairs, or unemployment. And as soon as I built up my cash reserve, I started to max out my Roth IRA, and that was in 2017. And I actually didn't get to contribute to my HSA until 2022 because I didn't have the high deductible health plan before that year. And 2 years later, my HSA as a self-employed individual is already over $10,000 invested with a bunch of receipts to claim later on. And my Roth IRA is well over 6 figures. And the next step was to max out the TSP. The only caveat to that is if your income, let's say it's less than $100,000 a year, then I would stick to 15, maybe 25%, but I would say that's probably even too much, but maybe 15% of your total taxable income. 25% is even better, but it really depends on the expenses and where you live. For example, if I made $100,000 a year, then I would just contribute up to the maximum for HSA, Roth IRA, and then contribute whatever is left to make up for that 15 to 25% of my total income towards the TSP. However, if you're close to your retirement age and you're way behind, let's say, on your retirement investments, you might not have a choice but to increase your retirement savings to 25% or more until you reach your retirement age. And on the other hand, if your net worth is way too heavy on your retirement investments, then you might want to keep your contributions under 25% while you build up your other asset classes in your overall portfolio. And once I prioritize my retirement investments, because they have the longest time horizon on my investment timeline, I put whatever I have left in my budget to invest in my daughter's college fund, real estate, and my travel fund because I absolutely love to travel. And since I became debt free in 2016, I told myself that I would start traveling as much as I can in my 30s and 40s before I get too old. I know you probably feel like your TSP, Roth IRA, and other taxable investments aren't making you money fast enough. And this is supposed to be a marathon, not a sprint. And when I was on my debt-free journey 10 years ago, I told myself that I would never get myself into that financial situation ever again. And I told myself that I would never let my daughter financially take care of me when I'm in my 60s or even 70s. I know a lot of people who are currently trapped in the paycheck to paycheck cycle, and I want to help you get out of it. And I didn't become financially solvent in one day. My net worth has slowly grown over the past 10 years because I prioritized paying off my high interest debt and then maximize my savings rate. And it's all about the savings rate and not always about the market returns. You can always schedule your free consultation with me by visiting firesuccess.com/coaching. If you don't see the schedule that you like, you can email me at hello@firesuccess.com.